when inflation is at 3% already, because you stimulate at 3%, we go to 12%, 15% inflation off of the same type of money printing that they did in 2020 through 2021. So in other words, it's most likely the mere fact that you're going to see the economy really stutter. I think you get into a recession in the second half. In fact, the Fed basically said that just a week ago. Interestingly enough, the stock market has ignored it. Risk assets have ignored that. But again, the Fed is telling us exactly what they're expecting. And I always look at it like it's going to be worse. If the Fed says something, always think 3 steps worse than what the Fed is telling us.
Gareth Soloway is the chief strategist of InTheMoneyStocks.com and the president of Verified Investing Education. Gareth notes that Bitcoin remains just underneath a major technical level of 30,500. This level represents a psychological barrier and a pivotal point for determining whether the low of the bear market has been reached. Gareth believes that there are more shoes to drop in the risk asset market and that the rally in Bitcoin may be a bear market rally. He cites the Federal Reserve's recent warning of a possible recession and the SEC's continued regulation of cryptocurrencies as factors that may negatively impact risk assets in the future. Despite this, Gareth notes that gold has been performing well and could be a positive asset to consider for investors. Soloway also sounds warning bells for recession, as he believes that the market is playing deaf to the warnings of the Fed. According to him, this will be very atrocious for the market because they would be caught off guard and things could easily go south. Let us now get into the video and explore Soloway's insights. Please remember to show your support by hitting the like button, subscribe, and drop your comments below. Enjoy.
So as of now, anyways, Bitcoin remains just underneath a major technical level, this 30,500 level. We've hammered on it. We can see, in fact, on the chart right here, lots of resistance. We've tried to push above it. Each time we're failing, at least at this point. Yesterday, we pulled back pretty sharply and then rallied back today as there's kind of a risk-on attitude back in the market. But the bottom line is this 30,500 level. Number one, it's an even number. So it's anytime you get above a 30,000 or a 40, there's always going to be a tendency to get kind of the last people in the trade, which weirdly enough is not the best thing, because once you get those last people in, you don't have a lot of new buyers. And so I think that's what's happening here with crypto. We're into this level where if we zoom out, this was the low from the 2021 bull market cycle. And it was also the low right here. And we've basically done a round trip. And I know I have a lot of lines on the chart, but we've done a round trip from that breakdown, which occurred in June of 2022, all the way back to where we are right now. So again, if we look back here, and again, this area here to here, that's where we're hammering on right now. And to me, that's a huge psychological level. And it's also a level where it will pivot me into thinking that the low is in. If we successfully hold above 30,500 for multiple days, I'm really looking for 5 to 7 days, then to me, you probably do have a low on Bitcoin in. As of now, I'm not convinced of it. I still think this is a bear market rally. I still think there's more shoes to drop in the risk asset market. The bear market of 2017, 2018, 2019. I mean, we had rallies from 3,500 all the way back to 10,000 and then back to 3,500. So you've had these bounces in Bitcoin that have actually even been bigger than what we're seeing here. We're just up around 100% or just under 100% versus back then it was 200%. So I think we have to keep that in mind. I also think that if you look at what the Fed has said, you have to be very careful here. So we do know that the SEC continues to sue and kind of put down regulation, or the beginning structure of regulation in crypto. And then the Federal Reserve just came out recently and said, hey guys, we expect a slight recession. And if you're anyone like me and you hear slight and the Fed saying slight and they said transitory and we saw what happened, you have to be nervous about risk assets in the future. And that's where I am. I honestly think that stock market's getting ready to have a second half that is going to be atrocious. And my guess is it drags down crypto as well. 10-year chart has this trend line here that we've bounced off of. My guess is we're headed back down there by the second half of this year. That would be around 3% on the 10-year. So I actually think there's further downside on the 10-year. Another ETF that's a great way to follow it is when yields go down, the TLT tends to go up. It's kind of an inverse ETF here. And you have this beautiful sideways channel of bullish consolidation, which eventually tells me that the TLT will move up, which tells me yields go down. The only way yields are going down is if we do get a recession or at least a slowing economy that's significant, which then basically makes the Fed potentially have to start backing off their rate hikes in the second half. Yeah, they said to expect, last week they said to expect a minor recession. a minor recession, or I don't know what the term was, but it was basically like, oh, just a tiny recession. But again, if you're like me, and I said this at the beginning, remember
Yeah.
they were like, oh yeah, we'll have inflation, but it's transitory. So it's one of those scenarios where, to me, they always try to sugarcoat because they don't want to scare the markets and cause a collapse. But smart investors have to start prepping for a worse recession than what they're saying. And again, that's just risk management.
Soloway has observed the market's amazing ability to ignore signs of a recession, such as Warren Buffett's recent statement on CNBC about his retailers' performance. In terms of indicators, Soloway believes that a recession is coming due to a significant slowing of the economy, which will cause the Fed to back off their rate hikes and ultimately, a drop in yields. He brought up Goldman Sachs' recent missed earnings report and discussed the ongoing banking crisis, noting that while Jamie Dimon has warned that it is not over, the market seems to be ignoring his warnings. Let's listen as Soloway talks about the recession warnings, the complacency of the market in reacting to the Fed's warnings, and a possibility of fresh bank crisis.
I've been inching into shorts. And again, I'm one of those type of people that as a trader, I've learned my lessons in the past. So I inch into positions. I don't go all in. So I've just been inching in one toe at a time in the water here on the short side of the market, a little bit of the Qs short, a little S&P short, and kind of just preparing for what I think is coming. And I also think going into earnings season, I mean, we're basically just starting earnings season now. There's going to be a lot of negative revisions, in my opinion, or lowered forecasts. And that's the market, to me, is not prepared for that. If you look at like the forward PE of Microsoft, the forward PE of Apple, there's no preparation for any type of recession in that valuation. And that will have to reset at some point when the market comes to that realization that the Fed is telling the truth, that there will be a recession. The markets don't care until they care, right? So last week on CNBC, I happened to catch Warren Buffett saying that he has a retailer that he owns, right, and that Berkshire Hathaway owns. Year over year, their sales of this retailer were down 22% year over year. So to me, that was a shocking statement. I mean, that is a massive decline in revenue, and the market again ignored it. Nothing big, nothing to see here, essentially. So those type of things I'm picking up when you have big players that know what they're talking, the David Teppers, the Warren Buffetts, these big name hedge funds that you have respect for because they're accurate. That's what I pick up on out there. This is the psychology of the market chart, right? So basically you have this run up. And to me, this run up that we've seen looked very much like the run that we saw from COVID all the way up to 2021. We've then had this sharp decline here. Now, look at the price action that we're seeing here in this psychology of the market chart. It's a lot of sideways to slightly up. Now, if I flip back to my S&P chart, okay, let's go back to this chart, and I want to go to my weekly chart. Look at what we've done here, okay? You have the same sort of sharp move up, getting to euphoria, the sharp move down. There's even this little pivot where we had a lower low, and then sideways consolidation. And so again, if you look at this down move and this choppiness, this is exactly the part within the psychology of the market that is going to tell us that this is the next down move to go. And just to reiterate, I want to switch back to that chart. Just remember what we just saw right there. And that's this part. We're right in the midst of this complacency period where people are saying, oh, it's, the bull market was so great. I want to revisit that. It's going to come back. I really hope it comes back. Let's just sit and wait here. And that's what leads us to this next period of downside via psychology of the market chart. So amazing how accurate and how the chart of the S&P 500 here follows this to a T, the complacency chart portion. Look at the crypto markets right now. They're as bullish in the crypto markets as we were when we were at 69,000. That's how quickly we've got back. That's complacency. They're basically saying, hey, listen, we're going back to all-time highs. To me, that's a red flashing warning sign out there to be very careful in this market. So another example of the markets ignoring what he's saying, right? So again, you have Jamie Dimon, who runs basically one of the biggest banks in the world, and he's telling you this is not over, yet the markets are like, it's over, no big deal. Let's keep buying the S&P 500. All right, if this is over, why is the KRE, which is the regional banking ETF, having literally no bounce here? I mean, this is, to me, a classic case of a bearish chart pattern, and that's got to be very concerning, the fact that the regionals still are not getting a bounce, especially when the Fed basically came out and said, hey, or the government said, hey, we'll make sure that depositors don't lose money, all these things. You even got a bunch of the big banks to put a ton of money in FRC, and here we are. The banking ETF for the regionals is basically at its lows. So there are things cooking here that, to be honest, right now, I would be shocked if we have not dropped significantly within the next 3 months in this stock market, in the S&P, in the NASDAQ.
Gareth Soloway is skeptical of the current market phase and comments that the market is conditioned to believe that the government and Federal Reserve will always rescue them. He expects that the market will not receive the same kind of bailouts as before because inflation is lower than 2%. Soloway thinks that a recession will come and the market is not prepared for it. He expects a decline of around 3,300 on the S&P 500 by year-end and 3,000 in early 2024. He also thinks that the market will eventually retest the coveted lows. The minutes from the March 21 and 22 meeting revealed policymakers for the first time predicted a mild recession in the U.S. starting later this year. They also showed that several members of the Federal Open Market Committee considered freezing interest rates following the turmoil in the banking sector in the run-up to the meeting. Those policymakers that argued for a pause and rate rises wanted time to assess the impact of the bank collapses on credit conditions in the U.S. economy, the minutes revealed. Ultimately, though, the FOMC decided to press ahead with a quarter-point rise to a new target range of 4.75% to 5%, but the minutes helped send the benchmark S&P 500 down 0.4% by yesterday's close, while the tech-heavy NASDAQ composite dropped 0.9%. Futures trading today indicates a small rise when trading resumes later. The Consumer Price Index rose 5% last month, according to the Bureau of Labor Statistics, compared with 6% in February. But core inflation, a closely watched measure that strips out volatile food and energy costs, rose 5.6% year-on-year in March, suggesting prices remain elevated in parts of the economy. Do you think the market is really complacent or things are not as bearish as it seems? Let us know your thoughts in the comment section below. Also remember to give us a thumbs up, subscribe, and turn on notifications for future videos. Thanks for watching.